this yo-yoing around where, the US is going to be positioned and what the US is going to do is throwing markets into all sorts. Maybe less so in Australia because you didn't necessarily see the Australian market move that much as a result of it. So perhaps people are starting to look through that and say, yep, this is just noise. But as we start to get closer to that, July 9th date, you're going to see some more volatility until, all of this negotiation, so to speak, is behind us.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, bit of deja vu this morning.
This is our third attempted recording because first one I didn't start the camera on the recording on my end, and the second one I accidentally pressed a button 6 or 7 minutes in and killed the recording from my end. So I'm not going to touch anything, but third time lucky.
Yeah, we're just practicing, right? We're trying to deliver so much value to our viewers and our listeners that we want to record things multiple times.
Hey, so we're pushing, what's this, 3.5 years? You'd think I'd know what I'm doing by now. Obviously not.
Old people in technology, Billy.
Andrew, what are we talking to everybody about today?
So we are talking again today about a market wrap. So we're going to run through what's been happening, how things have been tracking from a global market. And it's been an interesting month, to say the least, Bills.
Yeah, we'll talk a little bit about technology because we want to use Apple as an example because everybody loves that. But we always start with the S&P 500. So looking at the month of May and timestamping this, we are at the end of May here, up 5.89% for the month. Which, if you look at that by itself in isolation, it's absolutely huge. However, in saying that, you need to look through that because we are just seeing a recovery from softer months as well too.
Yeah, exactly right. So you look at it and say, yep, 5.89 is massive,
yeah.
But really it's really some making up some of that lost ground in prior months. Some really interesting data coming out and suggesting that investors are more underweight in US shares than what they have been historically, which I think is one, relatively unsurprising given some of the volatility that we've had in the US and what's been happening, but it does signal that there's maybe some weakening in confidence around the US market.
Not surprising because every time we turn on the news or every time Donald Trump wakes up, he seems to be doing something different.
Yeah.
So I'll give you a couple of examples on this, but on Friday, there was another threat to the EU that we're going to place, 50% tariffs on imported goods effective from June. So, those types of things aren't helpful for market confidence. And even when you look, I guess when, what did they call it? Liberation Day or whatever it was called. I think it was called, right? When he came down from the mountain with the tablets of the 10 commandments and basically had all of the percentages with the tariffs that he was going to impose. That period of time there was really volatile for markets. Bond markets started to really struggle a bit, so he had to backtrack. But then you saw the president turn around and basically say, okay, we're going to put a 90-day pause on this to give us time to negotiate. Now, that is coming up quickly, and that's going to expire on the 9th of July. So if deals aren't done, that 90 days, so if deals aren't done by then, which we're not really hearing a lot about those, but if deals aren't done by then, it creates further concern for the market because there's no predictability and there's less confidence, which means that there's more volatility because less people are willing to take a certain position because they're uncertain.
And I think the Eurozone's a really, I think it highlights some of the uncertainty in why markets are so all over the shop at the moment, because you look at it and say, okay, well, originally, on that Liberation Day, as they say, tariffs were originally set at 20%. And then all of a sudden, as you said, bond markets, started to experience some distress. And so you then, maybe someone taps Trump on the side and said, hey, let's ease up on all of this.
Yeah.
And so there was a pause on tariffs. So 90 days allowing for negotiations. Now, we haven't really heard much, if anything, about negotiations really taking place. And then on Friday, you're saying 50% tariff. So this yo-yoing around where, the US is going to be positioned and what the US is going to do is throwing markets into all sorts. Maybe less so in Australia because you didn't necessarily see the Australian market move that much as a result of it. So perhaps people are starting to look through that and say, yep, this is just noise. But as we start to get closer to that, July 9th date, you're going to see some more volatility until, all of this negotiation, so to speak, is behind us.
Yeah, I mean, look, talking about technology, I think using Apple is a good example to try and drive home some of these numbers and this concept as well too. So if you think about Apple as a company, and most people know Apple, right? Steve Jobs and all of that sort of stuff. Everybody knows Apple, right? So you think about how successful the company has been and how iconic it is in America's history and the tech story and, the aura of Steve Jobs and all of that sort of stuff. Trump is imposing, obviously he wants manufacturing of the Apple products to come back from China onto US soil, and he's speaking about imposing what are we talking about? A 25% tariff on iPhones and smartphones made overseas, so not in America, beginning late June. Now, I just had a look at the data before. The Chinese factories that are making Apple products employ 1 million people. So I get that there's 1 million jobs that you could automatically snap your finger and, bring back. It's going to take years and years to build that infrastructure. But you're doing so much damage to, a market, a company for 1 million jobs. It doesn't make any sense. It makes no sense whatsoever. And ultimately, the consumers are going to get hurt. Andrew, we've got some numbers and some data to talk about. What does it look like from, say, the cost of an iPhone if those tariffs are imposed?
And look, really rough numbers here, so probably going to butcher it, but an iPhone 16 was costing about $1,000 in the US, $1,000 US. Mm-hmm. You then say, okay, impose tariffs and all of that stuff. Cost of an iPhone for the end consumer is going to go up to about $1,300, let's say, approximately. Now, there's some data that was done that then looks at, okay, well, what if all of that manufacturing moved over to the US and you basically, could magically pick up the factory and move it to the US? Now, there's some other costs that need to happen in terms of moving factories, building that technology, building the infrastructure to support building it. But let's just forget about all of that stuff and just say, okay, manufacturing costs in the US versus China, cost of an iPhone will go to $2,500 or $2,400. Now, that cost is all paid for by the end consumer. So you then start to look at it and say, okay, well, yes, there are jobs that are ultimately produced, but number of people that purchase iPhones and purchase these products, is Apple even going to be the product of choice, for the end consumer at the end of the day? What impact is that going to have on the business? What impact is that going to have? I mean, you're looking at one business and one product. Yeah. What impact does that have on the broader economy? I mean, if you're talking about goods in the US increasing that substantially in cost in such a short period of time, you then start to have pressures on inflation.
Yep.
You then look at, okay, well, what does the Reserve Bank then do in relation to the interest rates? So there's just so much uncertainty. And truth be told, I don't think that anyone thinks this is all going to come in as, Trump is saying it, and this is all going to, come to fruition, that they're going to move manufacturing magically back to the US. And there's some negotiation that's happening in this, but where it's going to land is so uncertain that it's really thrown markets into a huge tailspin, and is kind of the only news story when you're talking about investment markets at the moment is talk of tariffs.
I just need to gaffer tape his mouth up and just let him not talk for a little bit. Look, we'll close on this one Apple, but 1 million jobs in China that he's talking about bringing back. I don't know if you've ever seen or heard of any of the working conditions and stuff like that in terms of where they make the phones. I don't think that Americans want these jobs. That's what my gut tells me. That's based on nothing other than my own sort of feeling and understanding of the American people. I don't think that's the case. So be careful what you wish for, I guess.
Yeah. But look, fundamentals in the US still suggesting that the economy is quite robust. So there is, the fears around a recession are subsiding, but there's certainly going to be some volatility with everything that's happening at the moment.
No doubt. And you can't, you can never bet against the American market. It's the biggest market in the world. They're extremely innovative. They're very adaptable. They move quickly. So, look, it's volatile, but once again, you've got very, very strong, robust businesses that will make decisions and take positions and, do what they need to do in order to navigate through this. And it's just, I think it's just what we're going to see with Donald Trump being president is that sort of that sort of stuff. But Andrew, let's pivot into China. Obviously, there's been some movement recently that suggests a bit of additional liquidity and things. Some really big numbers, probably doesn't get the airtime that it should. What's been happening over in China?
Yeah, I mean, look, the big story, and this is probably the first really substantial monetary response to US tariffs, and essentially what China has done, or People's Bank of China, they've reduced the amount of cash by 50 basis points, but, irrespective of what that number is, they've reduced the amount of cash that banks need to hold in reserves in order to ultimately lend out. Now, essentially what that's doing is increasing some money back into the economy and bringing in some more liquidity. And it's estimated that that's going to unlock, it's 1 trillion yuan. Apologies to any Chinese people if I have mispronounced that. But that's 138 billion US dollars in additional liquidity into the market. So they're really responding to the fact that, yes, tariffs are going to impact it, and the way that they're doing it is by starting to flood some liquidity back into the market and increase people's borrowing capacity, essentially.
Yeah, and just on that note, I mean, we don't know what's going to continue to happen between China and the US as well. Like what we were talking about with the US market before in terms of the uncertainty, I guess in terms of where both countries are positioning themselves, there is still uncertainty, and, that's going to continue to have levels of volatility. And yeah, like what you had mentioned before, it sounds like that the Chinese government, through the People's Bank of China, are taking steps in order to, make sure that things are still running as smoothly as possible. But we are going to see continued volatility, and I think there's more to play out in terms of where the US ends up and where China ends up, and how they're butting heads and what does that look like, and on what front as well too. So yeah.
Back home, Australian market, again, I mean, really similar to what normally happens, sort of following on from the US market, is up 4.2% for the month. Again, very similar story in relation to the fact that you look at that in isolation and it looks like there's, huge growth in Australia, but ultimately it's more of a recovery from prior months and returning to some form of normality after all of the, tariff, and not that we need to talk about it anymore, but some of the craziness of the last few months.
And look, it's good to see 4.2%, really great number. But once again, needing to take that into context and say, okay, what does it look like in conjunction with the previous months as well too? So hopefully we can see continued results like that if we just ignore everything that we've spoken about up until this point in time. So we'll wait and see. But some positive news. The RBA
Holders.
for mortgage holders.
Maybe not for people that have money in term deposits, or
that's it. The Reserve Bank of Australia gave their second rate cut and lowered the cash rate by 25 basis points to 3.85% is the official cash rate, which is great. There is still expectation of between, depending on which economist you listen to, 2 to 3 rate cuts this year. So it's going to be very welcome news for mortgage holders to try and give some relief from a cash flow perspective with the mortgage. If they're on a variable rate, how much they're paying each and every month. But it looks like over the next couple of months, we might see 1 or 2, and then they're predicting another one later in the year as well. So fingers crossed we get those 3 for those mortgage holders out there, but that'd be really nice.
great for you and I, Bill.
That's it. Absolutely.
Yeah, and I think that that's, some welcome news for mortgage holders because they've certainly had it pretty tough over the last couple of years. Um, I mean, expectation and some of the data that came out actually just yesterday was positive. Inflation is, expected to remain in that 2 to 3% band and sort of hitting that midpoint of 2 to 3%. So inflation has really started to, sit within the band that the RBA wants it to, which is great and is obviously, the reason why they're starting to reduce interest rates and starting to ease the pressure on sort of mortgage holders that are out there.
Yeah, so you've got inflation in terms of where that goes. So 2 to 3% is the band. You want to keep it in there. That's the optimal rate. But then on the flip side as well too, you've got GDP. So at what pace is your economy going to grow? Forecasts have been revised down for an annual GPT return. I'm thinking of Chat GPT. GDP from 2.4% down to 2.1. So if you think of, okay, inflation is where we need it to be. The outlook from an economic activity perspective has been revised down. Okay, maybe we just need to just turn up the heat a little bit with reducing the interest rates to try and make sure that the GDP forecast doesn't drop too much. And, they're inside the target band of inflation. So it does give the RBA the ability to be able to do that.
Yeah, exactly right. Billy, is it too early to say that they managed to land that soft landing?
Good question. I think it's too early, and it's probably slightly different. It's probably slightly different for us in Victoria versus other parts of the country. So if we take a little bit of a history lesson and we go back to COVID and low interest rates, low inflation, and then obviously everybody knows what happened since then. Victoria have spent and continue to do so in all of their wisdom.
It's a great budget that came out for today.
Spent a bucket load of money in order to support its people and lock us down and do all of that sort of stuff. Is it too early to say it's been successful? That's a good question. Read the soft landing. I think the question that we'll look back on in hindsight is say, was it the right move? Because at what cost?
Yep. And look, I think if you ask most Victorians, the answer is probably no. I mean, if you ask me, probably the answer is no, but everyone's going to have a different viewpoint on it. When you consider the impact that it's already had on Victorians in terms of the increased costs and the additional income that's needed to come from a state revenue perspective. Everyone knows your increased land tax costs and the COVID levy that's associated with that, which other states around Australia have not needed to do. Now, that's just the tip of the iceberg. I mean, you're talking about that as an immediate impact. Long term, I don't think that the deficit that's in Victoria is going to be solved now or in the next year, 2 or 3. I think that the impact is going to be, far longer. But I think that when you look at it from an Australian economy perspective, been much better than most people expected. I think better than maybe anyone expected. We were expecting some significant volatility, perhaps a recession, all of that stuff, and significant unemployment. Yeah. But being able to keep unemployment at a low level, still bring inflation back within that target band, GDP to still be ticking along. It was a pretty narrow path to ultimately, stick it. And I'm not saying that we have stuck it. I'm not saying that, the RBA's done the best job, but
done the best job with a set of bad.
Yeah, the set of bad circumstances. It's looking like things are very positive. Is essentially the point that I want to get across.
Yeah. And look, I'm with you if you compare it to other countries and stuff. I tend to agree. Talking about Victoria in particular, the government is condemning future generations, and the reckless spending is going to be detrimental. We saw that in the 80s and stuff, so I think it's a repeat of that. But if you think about what you were saying in terms of, better than expected, the cost of living is higher and families and households are under more pressure than they've ever been, even though inflation's now within target range, those prices ain't coming down.
Yeah.
They're staying there. It's just that they're not growing as fast. So if you look at that and you say, okay, is cost of living reflective of quality of life? I think our quality of life has gone backwards because people have got less discretionary income to spend.
Yeah. And it's going to take years to bring that back in, right? So
You've got to
yes, you can.
back up.
Exactly right. So yes, interest rates can come down. That's going to relieve some of the pressure, but you need wages really to pick up significantly more than what inflation is. So
Andrew, how do we tie a bow around this? Basically, stay the course, more volatility. Markets will do what markets will do.
Yep.
Trump will do what Trump will do.
manage what you can manage, which is your own cash flow, your own budget, your own strategy.
Andrew?
Thanks again, Bills, for the third time round. We made it to the end this time round. The video's still on. The audio's still on. We're good.
Fingers crossed, yes. Now, to our viewers and our listeners, thank you for your attention today. If you got some value out of it, please share it with your family and friends. If you don't already, please like and subscribe as well too. And we look forward to catching you on the next one.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.